Okay, so Financial Times drops a news story today. U.S. hits 1 kilo gold bars with tariffs in blow to refining hub Switzerland. I'm not going to read the whole article. You can find it online. But essentially, the U.S. slapped tariffs on imports of 1 kilo gold bars in a move that threatens to upend the global bullion market and deal a fresh blow to Switzerland, the world's largest refining hub. We'll scroll down and see that 1 kilo bars are the most common form traded on the COMEX, the world's largest gold future market, and comprise the bulk of Switzerland's bullion exports to the US. Not only does the COMEX get a lot of gold from bullion, but if you read below, gold is one of Switzerland's biggest exports to the US in general. And if we scroll down, you can see the financial part here. Switzerland exported, over the last rolling 12 months, they've exported $61.5 billion of gold to the US. With the tariffs today, that equals $24 billion in tariffs. So obviously, it's going to impact our market. We're on quickly here to talk a little bit about it. Keller, COO of SD Bullion, his phone's been ringing off the hooks. When something like this happens, he's one of the guys that people want to talk to because he's trading gold on an international stage and trying to figure out what does this mean. So Cole, thanks for joining me, and let's just talk real quick. What do we think this means specifically to our SD Bullion customer base?
Yeah, it's really exciting to kind of have in a couple different layers to it, and we'll peel it all back. One, this is the first actual interpretation of some of the legislation or ju- actions that have come out of the White House over the last couple months as it relates to tariffs. There have been these broad sweeping, hey, this is tariffed from these countries, and everyone kind of figures it out. Well, that means mayhem for a lot of people, and most industries can kind of absorb that because they're maybe making margins of 10 to 40%, depending on what they're doing, component parts, all that. Of course, gold, that's not the case. You're working off fractions of a percent. And so there's been this ambiguity about which tariff code actually applies. And so to kind of peel back the curtain a little bit behind the scenes, what's really been happening over the last, I think, 120 days, right, that we've been kind of dealing with this, is the theory was one code would get popped for a tariff if you brought in gold from Switzerland or from another place that was subject to tariffs. If you had it classified under a certain code, then that would then get slapped with a tariff, which is a no-go because you go from making maybe 1 to 3% on a deal to losing 10% on
Yep.
$3,500 an ounce. Massive losses. No one can recover from that. And that's why we saw the gold being brought over to New York at record numbers a couple months ago. There has been a different prevailing thought that an alternate code would be eligible to be bringing in all this other material and that would not be subject to tariffs. Well, actually, we see in the article was the Customs Border Protection Agency said they should be classified that kilo and 100-ounce bars, which are used for exchanges, which the most layman's term way of putting it is, I explained this to my wife earlier, actually. It's like, imagine if there was a tariff of moving money across borders or even
Yeah.
within the same border. It's like, that's really the equivalent of what it is. That they should be classified, the Customs Border Protection Agency said they should be classified under customs code subject to tariffs or levies, uh, according to a ruling letter dated July 31st. This just came out. And so on the heels of the Trump administration announcing additional tariffs against Switzerland, people may have that a little bit confused. The way I'm understanding it is this is just a interpretation, and this is how we're actually going to, someone finally posed the question, whereas everyone else hasn't been posing the question. So there's been all these trial balloons of inventories and shipments coming through from all these different places in the world into the U.S., discreetly getting bigger and bigger and bigger, where people are effectively testing how this will be treated. And to date, none of them, some of the shipments have been getting popped and they go back to wherever it is their origin country is. And some of them have been getting through under a certain code. It's
Yeah.
all very granular, but this changes that because now they're saying there is a ruling, and in the court of law, if they go off precedents, and they say now, yeah, there's a precedent for this, which is it should be hit with tariffs, which is really, really impactful because it just dries up liquidity like that, and it shifts all this emphasis over into the COMEX, which is an exchange that doesn't usually facilitate this, and then U.S. based production, because I think like 80% of the gold in that format, maybe more, in the world goes through Switzerland. In the U.S., probably it's a higher number, probably 95%. So it's just a massive, massive implication.
Right. So, yeah, it's pretty well known that Switzerland is the world's largest hub by leaps and bounds for processing, refining, and distributing gold throughout the world, especially the US. So, assuming this is I mean, it is the case, right? That's what the story
Yeah,
says. So, what do we expect to happen immediately in the physical gold market here in the
yeah,
US?
yeah. So it's going to, the short answer is refining is capped out, and we'll get into maybe why that is. The market for gold, the premiums are probably going to jump if we see any sort of a demand bump. If demand stays flatline, kind of like it has been, then there may be a little bit of a reaction, not a major reaction. If there is any sort of a bump in demand, then we're going to see premiums probably climb up as fast as they ever have, even including COVID, because people have to be so reactive because there's now zero ounces that can come in and service a lot of the back end transitional material that we can kind of count on, if that makes sense. So we've been enjoying record low premiums. I say we because I personally bought some ounces. Why wouldn't you at these premiums? And that's probably all subject to change at the snap of a fingers, maybe by the end of tomorrow's trading day, for all we know, which tomorrow would be Friday the 8th. So I'd say that's kind of the drastic scenario, but what's likely to happen, again, if we see any sort of demand wave at all, then all the secondary material will be kind of jumped up in price, and all the premiums across the board, no matter what gold product you're buying, will probably double.
Yeah, so the gold that we have on the shelves now as an industry, once that's sold, and then you're basically relying on the secondary market, which is sellbacks, right?
Yeah,
So if that doesn't stabilize the demand, that's whenever you're saying that's when premiums can go up because, well, you don't have the supply, and we operate in a physical space of supply and demand.
yeah,
So where does this really put the pressure? If gold kilos cannot come from
yeah,
Switzerland, and then you have the COMEX that needs gold kilos,
yeah.
where are they going to get the gold kilos from?
Yeah, great question. There's a couple U.S. based producers that can provide material into the exchanges. Eventually, the premium will be so massive that no matter who has the gold, they'll be so incentivized to service futures markets and sell into the exchanges. It's just the easiest money you can
Well,
get.
that's what we saw earlier in the year, right? Yeah.
Correct. Yeah, but the main thing is is all this raw material. First of all, refining has been occupied for the past couple months. It continues to be more occupied. All this material, as metal prices go up, gets sold into the broader dealer, secondary market. You name it. Either the coin shop down the street gets it first, and then he sells it to a bigger dealer, and then the dealer tries to sell it to or a wholesaler, and the wholesaler tries to sell it to a retailer. Eventually, everyone gets full up to the gills, and they're like, "I'm good. Tap
Yeah.
out. I got plenty of inventory. I'm actually low on cash." And so what do? To get liquidity, you have to go refine it. And so refiners have been pretty busy. But now you have local U.S. refiners that have already been busy with this tidal wave of everyone calling them saying, we need help, we need help, we need help. So it's going to it's a lit match. We'll see where it goes, right? If it finds its way into a can of gasoline, but that's how these markets always operate. It's always the wild card. What the other thing that, as we're talking about it, that we haven't even discussed until like just now, it hit me. Even new sovereign coins would be subject to really the same problems because this is going to upend everyone's ability to get raw gold. No matter if you're in the UK, if you're the Royal Mint, no matter if you're in Australia, it's going to upend all of it because it's going to tilt the board and all the marbles are going to go where people don't expect them for a period of a couple of weeks. And there's just not that much gold sitting in all these people's work in process inventory.
Yeah, it almost seems like the winner here, other than people in the U.S. that's going to benefit hugely from this is the Canadian Mint because when we had them on the podcast, they explained that basically they have all the gold they need in Canada to process, right? So in theory, they shouldn't need to import. And does Canada have any current tariffs on importing gold kilos into the U.S.?
Yeah, as of right now, no, that's protected under. We can find it later and add
Yeah.
it into the video. There's a certain U.S. Mexico Canada agreement. I think that's what it is, the USMCA, where it carves out quite a few exceptions, and it explicitly carves out things like this. So there should be no real restrictions. And in fact, Canada has been busy, and we saw a blip in the futures market, changes between New York and London. This is all very dry material. I get it, but it's how, this massive undercurrent of flow of metal between New York and London and how it impacts everyone downstream. That's really how it operates. And so they've been really busy from a refining capacity, as I understand it, for the past couple months anyway. And so, yes, they would be able to service some, which would be good business for them. But yeah, I think they'll probably stand to benefit. And you're 100% right. U.S. based companies that can handle quite a bit of demand and that are well positioned and well capitalized will be the people that would at all benefit. But it's going to be utter mayhem in the market.
Yeah, so I think let's maybe unpack. I think what I'm hearing is two scenarios for our customer base as a retail investor. Because look, I'm gonna speculate here. We've seen there's been so much happen in Trump's 7 months here in office, or I guess 6 months really. So
200
we've
days, I think, was today. I think they
okay,
were talking about in the news. Yeah, 200 days.
it feels like 200 years, but we've seen this where he goes out with a pretty big shock, and then definitely creates a
Yeah,
lot of riffraff in the markets, and then most of
yeah,
the time it seems like it's been kind of reeled
yep,
back in. So I think there's still uh, like you said earlier, there's lower demand on the retail side. There's still a good amount of inventory and a decent amount of secondary market. It's possible that if he reels this back in soon enough, it's possible that there's not a whiplash effect on premiums.
yeah,
That's one scenario, right?
yeah,
That's the good scenario, I guess, for the retail public. The worst scenario is this does in time create a shortage in physical gold, physical raw gold, and then you would have to see premiums spike pretty quickly to make up for that, right? That's basically the two
yeah,
scenarios we're looking at.
yeah, 100%. And you're spot on. I wouldn't predict this to stick. I think his past 200 days would kind of suggest that that's the course of action. Start off very aggressive, very high, and then kind of walk it back relatively quickly. So yeah, it's unlikely that this will still be a problem that we're dealing with in 3 to 4 weeks. In the event that it has such a massive impact on the industry that it's it's almost foolish to just, well, certainly in our positions, we can't just turn a blind eye and be like, yeah, he's going to walk it back. Like
Yeah, yeah,
there's a very real possibility that, within 12 hours, the premiums on everything jumps up quite a bit. So it's almost like planning for the black swan thing, but we're sitting there seeing the swan turn the corner and we're looking at it and we're like, yeah, I mean, I got good lighting here. That's a black swan. It's looking right at me, and it has a sign around its neck saying, I'm a black swan. I'm like, well, maybe I should react here.
yeah. So do you see? We talked about the price of the premium price for the metal. Do we think this is going to have any impact on the underlying market price of gold?
It's a great question. Uh, Kind of hard to predict. I would say I would say yes, because the people that have been the biggest, seemingly this year, that have driven the price action, been the biggest buyers, have been foreign central banks, and seeing a real needling of the liquidity of gold bars. If I've been a buyer in those offices, those governments, I'm probably just a little bit more motivated to get busy and buy more in the short term. Maybe if I have 4 months worth of purchases, maybe I escalate that and squeeze 4 months of buying into 2 or 1. And it's those types of things that, again, the exchanges won't be able to really handle that, because how they're going to want to buy it. They're going to buy it off the exchange. Well, everything we've been talking about is about inventory specifically designed, refined, and made to service exchanges and
Yeah.
contracts. And so that's the bottleneck here. There's always different bottlenecks in the market. In COVID, it was logistics and labor and in general availability of product as stuff shut down. This is an entirely different thing. It's a more dangerous thing. labor is labor. People can come back to work. You can turn presses back on. But yeah, I would say it's we'll see. I mean, I'll be really interested to see what James has to say tomorrow in his Friday weekly market report. Um, but I would say it probably lends to short-term price action in the positive for gold.
Yeah, I would have to think for the central banks, they're going to see this as a buying opportunity because this is really going to put a crunch on anybody that's producing and refining gold in Switzerland, which they don't just fund the U.S. Gold market; they fund the entire world market.
Yeah.
So they're going to need an outlet for the gold that they have that they're usually shipping to the U.S. that they're not. So I have to imagine the central banks are probably going to get some pretty good deals out of this, which could drive the price action up in the short run.
Yeah, what sort of deals do you think I mean, we're used to deals we see on just the low level that we feel like we play in. But if you're a central bank, like, what does that look like? A discount to spot by $2, and you back up the truck, literally an entire truck, 10 trucks.
Well, you know these refiners in Switzerland, they don't own the gold, right? So they're paying the bank for it. So you can imagine they're going to be motivated to get rid of it, right? Because I don't know what the interest rates are today, or the lease rates, but they
Yeah.
spiked pretty heavily last time this happened, and they were very motivated to get out of that position. So uh, we'll see how that turns out.
Yeah. So, like you said, circling back to what it means for the everyday, stacker, if you will, there's there continue to be kind of too good to be true, premium opportunities on a lot of popular bullion products. Pretty much every popular bullion product that you could think of. So with gold, yeah, your Krugerrands, your Britannias, your Eagles, your Buffaloes, all the above. The bars are probably going to be targeted for premium revisions. Let's just say that. But really, the place still to go is, and I'm going to be looking at it this evening and tomorrow, is just looking at what pre 33 decent condition coins can I get into it. Basically, premiums that are cheaper than what gold bars usually trade at. Because in a normal market, a gold bar is $30 or $40 over spot, and you can get some nice 100-year-old gold coins. Personally, I think that's a little bit cooler, and so I'm probably going to be personally looking at that.
Yeah. So I guess my last question here, and we'll wrap it up, is, if the COMEX needs Go Kilo bars to settle their contracts and they can't get them at the rate that they might need them, and we already know that the COMEX is short physical. I think everybody knows that follows, any level of reporting.
Yeah.
Is this a potential time that could really squeeze the COMEX here?
Yeah, uh, undoubtedly. The question is, can existing refining capacity service it? Yes. What level of commitment do they already have that's outstanding, and what's the price required to just say, I understand you have an obligation on a couple tons coming out of this refiner. You don't have to do anything. Let me pay you a premium for your time. It's like going to I've used this trick before. It's like whenever you have a pregnant wife and you go somewhere out in public and there's a long line at like a big event, like a baseball game or something. There's a long line for concessions. I just go up to the front and like, I'll pay for your food. I'll pay for your drink. You get it all for free. Just also order mine whenever you're ordering yours. Like, I'll pay you a premium for that action. And people are like, yeah, I'll take that. And so that's exactly what we would see. So yeah, it would, it will lead to some cracks, and we'll see just how sturdy that foundation is, as always.
Yeah. All right. Well, thanks for your time again. Big bomb in our industry today with the U.S. actually clarifying that, yes, there are tariffs on gold coming out of Switzerland, where most of the gold comes from that services the U.S. market and the world market. So we'll see how it all unwinds. But yeah, thanks for jumping in and giving us a little bit of insight from your side of the business.
Yeah, absolutely.